some of the the importance of having insurance. I mean, all too recent, we have had people in our lives that friends or family that has passed away, and they had to resort to GoFundMe, or they are giving contributions or one thing or the other. So we want to avoid that. I think that is a shame to any man that their family has to do that. I mean, I'm sure that a lot of us has insurance here, one insurance or the other. The whole purpose of this is to look at what we have to draw our attention to the small print so that we know that we are properly protected. And for those that don't have, to see the importance of having. There's so many types of protection policies that are out there, but there are three main types. So we have the income protection, the critical illness, and the life insurance, which I'll be talking about today, and then we'll be discussing on it. All right, so income protection. So if I were to ask you, what is your biggest asset? What would you say it was? I don't know if anybody knows what their biggest asset is. So if you were to tell me that your property is your biggest asset, your car is your biggest asset, I would say that I would beg to disagree with you, because the biggest asset to anyone is the ability to be able to earn income. So that is our biggest asset, because if we have the ability, we can make it back again. So when the ability to earn income stops, everything stops, which is why income protection is very, very important. A lot of people don't know about income protection. What it basically means is it's a regular payment that pays you like a salary if you are not able to work due to accident or illness or injury. Yeah. So it pays usually about 60% of your income. It doesn't pay the full of, it's not allowed to pay the full income, but 60%, which means so many commitments that we might have. And when it says a broader definition of illness, it's not just for critical illness. I mean, stress will fall under if you have stress and you can't work due to stress, it falls under income protection. Yeah, if you fall down the stairs under income protection and you can't go to work. And with income protection, we can make a lot of multiple claims, and I'll tell you more about it as we go along. Right. So with income protection, if you do go for it, there's suited. This is part of the small prints, again, that we have to pay attention to. When we say own income protection, it gives you protection for your own job, your own occupation. If you have you're incapable of doing your own occupation, it pays you. For example, to give an example, a high pressure job that leads to high stress levels means that you can no longer fulfill the duties of your occupation. Even if, say, for instance, you work from home, you do something virtually, and then you can't do it for one reason or the other because you feel pressured. You can claim under income protection, and they'll pay you. Stress, like I said, is a valid reason. Now, and this own income protection is a bit more expensive than suited, but suited is not good. Suited, the company has a right to find a job that they think that you are suited to, an occupation based on your skills, training, and qualification. So you say you can't work because of one thing or the other. They say, look, but you can also do this, you can also do that. And we don't want an insurance company to be telling us what we are able to do or what we are not able to do. So when I propose income protection for my customers, I always go for own occupation. And when you say own occupation, it could be you could be a what do you call it, a nurse today, you could be doing something else tomorrow. Your occupation is your occupation. It doesn't mean that you have to have one specific occupation. I don't know whether you understand what I mean. So pros and cons of income protection. Like I said, if you are not able to make an income, everything stops. So it gives you peace of mind if you have it in place. Yeah. It's like a financial security, and you're able to maintain your standard of living for yourself and your family. Compared to life insurance and critical illness is cheaper. Yeah. And usually high rate of acceptance with no medical checks. Less paperwork involved. It's very straightforward. The proposal of the income protection takes less than 10 minutes. Pays out if you can't walk, like I said. and it's flexible. Different options and flexible can suit your budget. I mean, in terms of the premiums. So let's say that you say you want to be getting £2,000, for instance, in a month, and the premiums comes to like £30. You say, okay, what about if you want to reduce it? If I want to reduce it to 1,008, then the premiums comes down. And then you can claim more than once on the same policy. For instance, when you take out income protection, there's a deferred period, yeah, and there's a term. So, for instance, the deferred period could be a month. Just be careful. If you have a job that pays you sick pay, you have to defer it for that. Say, for instance, you work with the NHS, yeah, and I'll show you that in a minute. So, if they're going to pay you for like 3 months, then you have to have a deferred period for 3 months for your income protection to kick in. So it can only start when that one stops. Yeah. So, but the cons, income protection can be costly, and it can only be costly for people that have pre-existing conditions. Yeah. People that do risky jobs. Yeah. People that I mean, they won't even take people that have dangerous hobbies. People that are smokers, people that excessively drink, because these are some of the questions that they will ask you when they are proposing. How many pints do you drink in a week? Do you drink spirits and all that? And if they think that you are drinking too much, they might bump up the price. They might load it. Policies are bought in bulk, so are not tailored to your needs. I will explain that in the next slide. Yeah, that means you're paying for something that you're not but less flexible on your policy. You may not be able to adjust the policy. Unlike life and critical illness, you can't really adjust the policy like that. They don't allow you. I think they only allow you 5 times for the life of the policy. So, for instance, if you want to reduce how much you get paid in a month, you can easily do that. But if you want to increase how much you want to get paid in a month, they will have to do. They'll have to evaluate and see the risks that they have to underwrite it again, basically underwrite it again. That's what it means. So, but it's not as flexible as the life and income and critical illness, but it's also there. Now, this is sick pay for the NHS. A lot of people have done a lot of people that work with the NHS. So, for instance, during the first year of service, 1 month, receives full pay for 1 month, yeah, and receives half pay for 2 months. So the income protection can kick in after month 2. So how it works is that it will top up the payment, the half pay to become full pay month 2, and then when the thing stops, I mean, when the period stops with the company that you're with, then it goes back to full pay, and I mean, 60% of what you used to earn. So in NHS during this second year of service, it's 2 months. It kicks out in after 2 months. Third year of service, 4 months, and that is how it goes. So this is how. But with this one, this sick pay, with NHS, it doesn't cover as much as what the income protection covers. So the income protection have a wide range, but with this sick pay, you have to be really, really sick with the NHS before they start allow you to be homesick, and they'll be paying you. But then again, with income protection, if you have something else out there, it's always good. It gives you a broader range of illnesses. So like I said, stress is one of them. Now, I'm going to move to critical illness. Critical illness is another product that a lot of us has taken out. I've seen quite a lot of policies taken out for critical illness, and I've done for a few people too. Now, critical illness pays you a lump sum on diagnosis of certain life-threatening or debilitating illnesses, but it has to be serious. So it has to be either critical or terminal. Yeah. So things like heart attack, stroke, cancer, major organ transplant are some of them. It pays out once, and once it pays out, that's it. It's just a one payout. So if you do critical illness for 50,000, if you are critically ill, they pay out the 50,000, and that's it. They're done with. Single lump sum payments. and a lot of them pay on diagnosis. Yeah. So the providers that we use, a lot of them pay on once they diagnose, they pay for surgery. And the main benefits could help take away financial worries, like because to keep the life going on, because at that time you won't be able to make an income. And it could help pay mortgages, bills, and all whatnot. Yeah. But again, you have to consider what it's worth, because most critical illness covers set as many of 65 to 70, and people usually become critically ill when they advance in age. Yeah. If you ask me, if you have to pick between critical illness and income protection, I'd rather go for income protection any day, anytime, because with that one, you know that you're getting paid if you're not working. But with critical illness, things have gone really, really bad before it gets to the point of where you're critically ill. So that's the difference between the two. And they're a lot more expensive, yeah? So the exclusions to critical illness. So for those that have taken out critical illness already and you don't know, if you do something that is injurious to your health, they won't pay. I mean, if you know and you do it. So alcohol or drug abuse, the policy will not pay out. From high consumption of alcohol or your overdose on drugs, self-overdose on drugs, and illegal or criminal act. Critical illness pay for loss of limbs or loss of um, or body parts. But if you are caught stealing and you cut your hand on the, so they won't pay out of that because it's a criminal act. So they won't pay for criminal acts. So aviation, other than a fair paying passenger on a commercial flight, they won't pay because they think they're quite hazardous. And hazardous activities, sports like mountaineering, caving, and all those high risk sports, martial arts, jet skiing, underwater diving. So they will ask you these questions before they even give you the policy. Yeah. And if you take that you do jet ski, they might not accept you because they want to hedge their risk, because they're also in the business. The if you have high probability of being critically ill, it reduces the chances of you getting a policy, or even if you do get a policy, it increases the price of that policy. So HIV/AIDS, non-life-threatening illnesses, critical policies do not cover non-life-threatening illnesses. The income protection does. Pre-existing, they won't take you if they do take you, they won't pay out if something happens based on those pre-existing illnesses. So they'll know. They'll tell you it's always in the small print, and sometimes you don't know. So because someone has asked me that before that the mother was in hospital, that can she now take out critical illness policy? I said it's unfortunate. If it's for the sickness that she's been admitted for, they won't be able to avoid. Something else happens, they might, yeah. So, and everything is for people that live here in the UK, not outside. All the policies, yeah. But if you're sorry, just before you go, if you're a resident in the UK and you travel and something happens to you there, you're still covered, but you have to be resident in the UK. So the big one is life insurance. Very, very important. Right. Sometimes they call it life assurance. A lot of times it's the same thing. The first two products that I showed you, the income protection and the critical illness, is for you when you are alive, so you benefit from it. But life insurance is majorly for your beneficiaries. That's your family or your loved ones. So provides security for people that you depend on. So there are different types of life insurance. The most appropriate with dependent persons. Let's look at the different types. We have term life insurance, term life cover, and we have whole of life cover. Now, term life cover is exactly as it says in the tin. It's for a specific term. It could be 25 years, it could be 20 years, it could be 30 years, and it expires after that term. Yeah. While the whole of life cover is from the point you take that whole of life cover to the point one dies, it covers you, even if you're as old as 120 years old. As long as you're paying your premium, it covers you. So And it's a fallacy to think that you only get paid the payout once you die. It's not that. If you have terminal illness and you have a diagnosis of life expectancy for less than 12 months, a lot of our providers will pay out the money to you. So, or they pay out the money to your beneficiaries once they have that diagnosis. So it's either death or diagnosis of life expectancy of less than 12 months, they will pay out. So that is, and term life insurance, whole of life cover, they pay a lump sum, which is tax-free to your beneficiaries in the event of your passing away. Right, so pros and cons of life cover. When you have term life cover, it's for a term. It's quite affordable, yeah, and obviously meets the financial obligations, and it's temporary. When it's temporary, it's for that term. Yeah, it covers whenever I propose a term life insurance for people, I always ask for the cost of their mortgage. Yeah, so make sure at least it covers that cost of their mortgage and or more. Yeah, so mortgage, if you have child college education that you're paying for, private education or university education, you want to include it, it's entirely up to you. It just provides for financial safety, but like I said, it's temporary for the term that you have taken. So if it's 20 years, after the 20 years, the policy will lapse. So it's no guaranteed payout. Yeah, will only pay out if you pass away within that policy term. If not, the policy expires. And you have to do an additional cover at that time. Okay, now there are different types of life life cover. There's decreasing term, there's level term. Now, when you buy a mortgage and the mortgage advisor tells you need to do life cover, usually most of the time they do decreasing term. And I always advise people strongly against decreasing term. Level term pays the same during the policy term unless changes are made to that policy. So it's level, it doesn't change, regardless of whether the person passes away on day 1 or day 20 or year 20. It pays the same amount. It's just level. But decreasing term is always attached to the mortgage. So let's say, for instance, you buy a mortgage of 350,000 and you take a decreasing term insurance. At the inception of the policy, the cover is for 350,000. 10 years down the line, you're making repayment. Let's say it's a repayment mortgage. You're making payments. Now, the amount outstanding on your mortgage comes down to like maybe 220. Yeah. So the policy that was for 350 is now worth only 220. And maybe in year 20, it's 50,000. So the policy that was for 350 is now worth 50,000. So it continues to go down, and then it only pays out the outstanding on your mortgage. Now the problem is this: you might have a big mortgage, and if something happens to you, you're rest assured that your family can still stay in that house. But will they be able to maintain that house? Will they think that that house is big? I mean, too big for them? Do you think they might want to downsize? Or maybe the children actually want to get their own houses. They don't have anything. Everything is locked into that house. And when it's locked into that house, before they get it, it takes time, because we have to talk about something we call probate. It just takes time to sell the house that is not theirs and to get the money. And if you sell the house that is not yours, you get the money. There's a possibility that you pay inheritance tax. And then inheritance tax is the big problem. It's like 40%. So why is term life better? It's not just covers the mortgage, but other expenses. Yeah. So you have flexibility of what you want to use that money for. I mean, they have flexibility of what they want to use that money for. The kids, your wife, yeah, they have flexibility. So they give them a fixed, especially when it's put in trust. It pays out within 2 weeks to the beneficiaries, and it pays out exactly how much you have, the percentage you have dedicated to each person, to each child. For instance, with my family, I've got 3 kids with my wife, and I printed it out for them. So this is how much everybody will be out of the 350,000, which is my mortgage, you know, this is how much percentage you'll be getting, how much you'll be getting, you know. So I pray that they don't poison me one day because of the money, but if you know what I mean. But it just goes that you show that you care about your family, and then they know that you care about them. You're thinking about them even when you're not around. So it maintains the value throughout time insurance. And then if you, regardless how far into the policy, I've told you that. So level time is always better. If you have a decreasing term, I'd advise you to have a look at it and try and change it to level term, because then you're properly protecting your family. Right, let's take a look at the typical insurance policy and what it, the information it contains, yeah? So a typical insurance policy will have the policy reference number, to tell you the what it's covering, lifetime assurance, amount, the date that it starts, the premium that you're paying, yeah? It tells you, it replaces any previous, all their jargon and the way they talk. And it just tells you that it's what is in force now. And it tells you, sometimes it tells you the expiry date. That is if you maintain your the premiums, and it gives you the name. And again, LTA means lifetime insurance. Furthermore, it tells you how much you're short for. Yeah. Now, I want you to take proper look at those things that I put in red. The sum assured increases throughout the term of the policy. The premium is that this is based on initial assured and will increase each year to reflect the increasing cover. So that means you have taken increasing cover. Increasing cover means it's attached to something we call retail price index, RPI. So if you see that you take out an insurance policy this year for like £59.23, and next year is suddenly £62, and the following year it's suddenly £64.50. That means it's on RPI, retail price index. Retail price index goes up with the rate of inflation. What they're trying to say is that, okay, what £350 can buy now, in the next 5 years, it might not be able to buy. What the value of £350,000 today is maybe 355,000 in 5 years' time. So as your premium is going up, the sum assured is also going up. Yeah. So, but not everybody wants this, because not everybody can control it. When people take out insurance, they look at their budget and they say, okay, I've got a budget of £60. I don't want to go over £60, and they take it out. But if you're not careful, and you don't look at the small print, and you don't check that it's not attached to RPI, that it's guaranteed, then it rises. But the good thing about it is that you can always call the insurance company to say that you don't want the rise, you want to stop it, and you can stop it. Yeah. So move on to the next slide, please. Right. So these are some of the changes you can make to your cover, to your policy. Yeah. So you can reduce the sum assured without any underwriting or anything easily. You can stop the increases, which I've just said. If it's increasing every year, you're noticing, just tell them that you don't want RPI, you want it taken out, you want it to be a set, and they'll stop it. You can reduce the term. Yeah. Some allows you to add another person to the cover, but most will tell you to start a new cover if you want to have joint cover, say for instance with your partner. Yeah. You can change how often you pay your premiums. Some people say they want to pay quarterly every year. Some people say they want to pay weekly, depending on which suit them. Some insurance company will allow you to change how often you pay. But when it comes to increasing the sum assured or increasing the term of the cover, it's possible, but it has to undergo underwriting. They have to look at they want to know why you want to increase it. Maybe you have some sort of illness that you're not disclosing. They're going to do underwriting. They're going to get in touch with your GP. They want to know what exactly is happening. So if everything is fine, if it's increasing, they'll tell you how much more you have to pay on top of what you're paying, and then they'll give you the cover. If it's not going to be possible, they're not going to cancel your cover. It's going to remain the same. So they're just going to tell you it's not possible. Okay. Right. So why life insurance, why they don't pay out? Yeah, this is a big question, and this is the bugbear of so many people. That's why they don't want to take insurance. They say when it comes to claim, they don't pay, and it's not really true. But in the UK, 96.9% of life insurance claims are successful. However, there's a small handful of occasions when a claim can be declined. And these are some of it. If you fail to give full disclosure at the start of the policy, I cannot stress this enough. This is the most important thing when you're setting up an insurance a cover for yourself. So let me give you an example. So they say, I asked you, I mean, do you have any medical issues, or do you have any diseases, or are you using any medication? I don't even ask them anything. I ask them about the medication now, just to be sure. And if they say no, when somebody's proposing insurance for you, and if you say no, no, no to all these questions, they don't feel they have to get further information from your GP. They'll probably cover you. Yeah. Because you haven't fully disclosed, they don't know what they're doing. But if you disclose to them that you have diabetes or you have high blood pressure, yeah, they might decide that they want to get more information from your GP, which I always like, because then there's no issues when it comes to claiming. They can't say they don't know everything about you. But when you don't disclose, when it comes to the point of claim, they will go back to that GP and confirm. Insurance investigators are they are worse than the what do you call it, Scotland Yard. They can find out information when they want to find out, and if they see a discrepancy, that was one of the big problems. They don't pay out. Sometimes they might pay, or they might not pay in full. No, I mean, sometimes they might pay a percentage, and they might not pay in full, or most times they won't even pay anything because of non-disclosure. Fraud is another issue. I mean, if you say you are something that you are not, you have to be very careful. High risk activities. In the beginning, when they are setting up the policy for you, they'll ask you, are you into high risk sports? Yeah, mountain climbing, or all this. You have to be open and honest at that time. If you are not, then you won't have any problem. But these people are into business too. They want to take their risks. Suicide clauses. Suicide clauses is you take out an insurance policy, and you know that you're insured for $1 million, and then you think that things are difficult for. I mean, it's time to go, and I'll overdose myself and kill myself so that my family will get it. They won't pay out. They won't pay out on suicide because you did it yourself. So it's not something inflicted on you. So a lot of companies won't pay out, but I've seen one or two that will pay out after 1 year. So it's policy expiration, obviously you know that. And if policy, or and then the beneficiaries getting involved in insurance, that they'll do the investigation. They want to know that everything is clean. Policy doesn't pass away during policy holder. If you don't pass away during the term, and the term has expired, then the payout would not come. So if your circumstances change and you don't inform the insurer, if you fail to pay your premiums. Now, circumstances change and you don't inform the insurer means, this is it. Have you taken up smoking? That because they actually propose the policy for you as a non-smoker. And if you're taking up smoking, that means your risk increases. Or if you quit smoking, and for a certain number of years, if you tell them, they might even reduce the premium that you pay. Have you been diagnosed with a critical or ongoing illness? So if you have been diagnosed with a critical illness that is probably terminal, they can get paid even before death. Have you gained significant amount of weight? These are some of the things they want to know, because they want to know that okay, you're really taking care of it. There are some providers that do if you are getting involved, you're going to the gym, you're walking, you're doing exercises, it brings down the actual cost of your premium. Yeah, because they see that you're taking good care of your health. But if you're not, and this is the way they know, they have an app that attaches to your could be on your smartphone. They can actually monitor your activities, and they'll send you notifications that well done, dude. And then the insurance reduces. Are you expecting an addition to the family? If you have an addition to the family, you need to tell them that means your beneficiaries are increasing so that they know, and then you can put them in trust. Are you married or are you divorced? So if you're married, if you took it out when you were not married, you need to know your next of kin. Or are you divorced? They need to know that she's no more your next of kin, and who they will ask for your next of kin or your beneficiaries. I'm weary of time. I don't want to ask questions. Now, insurance policy must have. So based on my experience, these are the things that I look for when I review existing policies to make sure that they're airtight and they serve the purpose with which they're taken. So waiver of premiums, guarantees, indexation, trust, fracture cover, private GP. Let's move on to the next one. So waiver of premiums is very important. Waiver of premiums is if you take out a policy and, for instance, about 2-3 years down the line, you lost your job and you can't work and you don't have income. If you have waiver of premium attached to your policy, they can waive the premium for up to 6 months. Now, which means that you are still covered, but they're not taking anything from you for 6 months because of your circumstance. So if you're too ill to work, and then if you make a claim, they stop taking premium whilst the claim is ongoing. So waiver of premium is very, very essential to having your policy. Guarantee. This goes back to what I said initially. When you set up a policy and you say, okay, Larry, my budget is £40. I don't want to exceed £40. What we do is we guarantee that £40 for the life of the policy. Say, for instance, we take it out for, you say you want to take a 30 years policy and you don't want to pay more than £30 and it's for maybe £200,000. So we guarantee that £30. It doesn't increase. But if you don't do that, then it goes into RPI. Then it goes up gradually every year. Fracture cover. A lot of our providers include fracture cover with the policies now. Yeah. So you can have multiple claims in a year for up to 4,000 for fracture. Yeah. For travel costs, it covers so many things. So mostly for yourself and your family, including your children. So they'll pay the cost up to 4,000 a year. And fracture cover is good. In the event that, say for instance, you took out income protection and you fell down the stairs and you have a fracture, yeah, you get this very, very quickly, this fracture cover within a few days, yeah. And whilst the income protection is being processed, if you know what I mean. So this fracture just comes with it. It's a quick payment to help sort out your commitments whilst you're taking care of yourself before the income protection kicks in, if it's going to be a long-term process. Now, indexation is what I've told you about, where the amount of money you pay every year or every 5 years increase. It's just like when you take out a car insurance and after a year, the insurance writes you that this year your premium has gone up to so and so price. You have the right to say yes, or you go back to comparethemarket.com or which is an online broker anyway, to find a better deal for yourself. So you have the right to refuse indexation. You can say, I don't want an increase. I want it the way it is. So just make sure that you tell them and they'll put a stop to it. You can decline the increase at any time. Now, this is the most important part of the policies, the things that you have to have in your policy, the trust. A lot of people don't have trust. A lot of people don't even know what trust is. Trust is a legal that allows a third party to hold and manage assets. Some of us do know what it is, but it's very important to have it as included in our policy. Now, life insurance that I've seen when I'm reviewing policies that don't have trust, they're liable for a 40% inheritance tax by the government. So let's say you're covered for 100,000 that's going to go to your beneficiaries. Now, if you don't have trust, the government will take 40%, which is 40,000 out of that money, and then 60,000 goes into probate. Now, probate takes a while. I mean, just to tell you a story, I have an auntie in Nigeria, has only 2 kids, yeah, and she's well-to-do. She has a lot of houses. She has quite a lot of money. Now, when she died, everything went into probate, yeah, and till now, she died. I think she died in February this year. They haven't been able to get anything out because they're using lawyers to try and get it. And as it happened in Nigeria, it happens here too. So, which is why trust is very important. So, what does trust do? It minimizes estate taxes. Yeah, it's excluded from taxable what the government can tax. So it's not federal, it's not subject to taxes. So 40%, I mean, they keep it away from the government, so they pay the beneficiary the whole of the 100%. Now, how do you know that your policy is from what you have already? How do you know that your policy is in trust? This is the way you know. When you are setting up that policy, if it is in trust, they will ask you, okay, you want to be covered for 400,000. How much of that 400,000 should go to your first son in terms of percentages? And if you say, okay, Tola should get 25%, then the sister should get 25%, their mom should get 30%, and the little one. So if you do that at the beginning of the policy, yeah, and you've splitted the whole of the money, which is 100% of the money, that means it's in trust. If you haven't done that, that means you stand the risk of the government taking 40% as inheritance tax from the payout to your family. Yeah. So eliminating gift taxes, it allows the trust to transfer the treated as a present. Future gifts get taxed. Like when somebody dies and you will something to someone, inheritance tax will go on it. So it doesn't. It preserves government benefits. So any benefit that that the beneficiaries are already getting, it doesn't affect it at all. The creditors cannot come for it. It's not possible. And the insurance company or whoever you nominate control the distribution. And you can even put, if you have grandchildren, yeah, and if you have one coming on the way that is not even born yet, you can put them into trust. You can do that, and you can will something to them. So it's tax-free. They get the money within 2 weeks. Your beneficiaries get the money within 2 weeks tax-free. There's nothing as sweet as that. Yeah. Next slide, please. Right. Unlimited access to GP. They started doing this a few years ago. They realized the long wait in GP waiting rooms that most of our providers give you unlimited. They take your details from your GP, they hold it, and you can call them from anywhere. So even as a matter of fact, you can call them once you're abroad. If you travel to Nigeria, for instance, something happened to you, you can call them and give them your policy number, your date of birth, blah, 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 your address. And you tell them exactly, they can give you a prescription, which they can send to you via email. And you can go and get at any pharmacy to use to take care of yourself, anywhere you are in the world. So there's nothing as good as that. So you have unlimited GP access to a lot of our providers. I think that should be the end of my presentation.